Hello and welcome back to our talking points. Now, for those who are new, this is a gathering place of people who want to learn how to become successful investors. And our methods, while they might seem a little bit controversial, have been tried and tested since 1996. We registered our first double trust structure in South Africa. But if you want to find out more about that, then stick around to the end of this video. Now, for today's talking points, we're going to be looking at the Conduit Principle in a little bit more detail. And for those who know the basics about trusts as a vehicle for investment, you'll know that the taxation on a trust is quite high. And in fact, it's around 45%, which is why many people would rather ask, why on earth would we advocate to use a trust to protect our assets? Well, these are obviously the people who don't know about the amazing principles in place in South Africa that can help you actually save tax. And one of those is the Conduit Principle. Now, this is quite a complex principle, so it's not something that you can do without the right qualified destinata accountants who specialize in this kind of accounting. But to give you a little bit more of a glimpse into the wonderful thing known as the Conduit Principle, I've got Shantel Nel, the Chief Technical Officer of Destinata Capital and Destinata Accounting, joining us today. Shantel, thanks so much for joining us.
Thank you, Damien.
Now, could you just tell people at home who might not know, what is the Conduit Principle?
Okay, so the Conduit Principle determines that the income or gain received by the trust can be distributed to the trust beneficiaries and taxed in their personal capacity instead of in the trust.
But now, Shantel, who are those beneficiaries that the Conduit Principle can actually apply to?
Well, any beneficiary listed on the trust deed that has an income tax number.
Shantel, why would it be more beneficial to distribute the profits or gains than to a beneficiary?
Well, the profit or gain distributed to the beneficiary will be taxed against his or her personal tax bracket and not the 45% in the trust. If the beneficiary receives no other income and the distribution is 87,300 Rand or less, no tax will be payable. However, it still needs to be declared.
And then what happens in the case if the interest is more than the allowable 100,000 Rand donation for the year?
Any amount that exceeds the 100,000 amount of 100,000 Rand amount will be allocated as an expense in the trust, and therefore the trustee or individual will need to declare in their personal name as interest received.
And then Shantel, just the last question. Let's say, for instance, you are a member of the Wealth Masters Club and you're using the service provider, and your subscription fees from the different service providers are then deducted from the family trust. Should you then move that debit order over to the property trust? And if so, why do you think we should do that?
Well, the family trust receives no income and therefore there is no tax benefit for these expenses in a non-trading trust. So these expenses can be used against the income in the property trust. So it will be better.
Fantastic. Shantel, thank you so much for your insights. Now, like I said, this is merely just the tip of the iceberg of what there is to know about the entire principle. So if you'd like to find out more, then you can join us for a free training, which is streaming place from Saturday morning, where we will show you how you can become a property investor using other people's time, other people's money, and other people's skills. So if you want to find out more about that, look at the description below. There is a link where you can register. And we have our training both in English and Afrikaans, so make sure you select what is best for you. And we hope to see you this weekend. So until then, goodbye.